This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do.
Getting hammered. A key housing statistic gets nailed as housing starts drop double digits in November. And now, builders and buyers alike must confront rising interest rates.
Shifting into reverse, could renegotiating the trade deal called NAFTA cause the auto industry to lose jobs, not save them?
Five-star fund, our top-ranked market monitor, has a list of stocks he says could rise 20% over the next year and a half. Those stories and more tonight on Nightly Business Report for Friday, December 16th.
Good evening, everyone, and welcome. Home building slowed down last month. Housing starts, which measure the number of homes that broke ground, tumbled from a 9-year high. According to the latest report from the Commerce Department, starts dropped by more than 18% in November. That was the largest decline in almost 2 years. As we've been reporting, the housing market is in need of new homes. Inventory has been persistently low, which has helped prop up prices. And some leading economists say that although the housing market remains on solid footing, the data may be the latest sign of slower economic growth in the fourth quarter.
And while many do expect the housing market to remain on that solid footing, it is getting more expensive to finance a home. Mortgage rates are now at their highest levels in more than 2 years, and as Diana Olick explains, payments are also going up for people with home equity lines of credit.
Interest rates are rising, and while most homeowners today have fixed-rate mortgages, millions of them also have home equity lines of credit, or HELOCs, which are suddenly getting more expensive. These second loans are generally adjustable rate tied to shorter-term interest rates, and that means the payment changes once a year. Higher interest rates mean higher payments. HELOCs were all the rage during the loose lending days of the housing boom when homeowners used their properties as ATMs. Originations for HELOCs peaked at just over $367 billion worth in 2005. Their popularity then dropped dramatically along with home values to just short of $67 billion by 2010, according to CoreLogic. Then, as home prices mounted and borrowers regained sizable equity, HELOC originations jumped back again in 2014 and 15 and should reach a collective $173 billion worth this year. Not all HELOC borrowers actually use all of the line of credit, but for those who use some or all of it, they will see higher monthly payments as interest rates rise. The increases could average about $100 or more per month, but depend on the size of the loan. Unfortunately, recent surveys show a large share of HELOC borrowers have no financial plan for these changes, and some are unaware their monthly bills are going up. For Nightly Business Report, I'm Diana Olick in Washington.
On Wall Street, stocks closed slightly lower. The major indexes gave up their opening gains after Reuters reported that a Chinese Navy warship seized an underwater drone deployed by an American vessel in the South China Sea. By the close, the Dow Jones Industrial Average dropped 8 points to 19,843. The Nasdaq was off 19, and the S&P 500 fell nearly 4. All of the major averages barely budged for the week.
Two Federal Reserve officials are speaking about interest rates just days after the central bank raised them for the first time in a year. The St. Louis Fed President James Bullard changed his outlook because of the recent rise in bond yields and now says there's a need for an additional hike next year. Separately, Jeffrey Lacker, the head of the Richmond Fed, said the central bank will likely need to increase rates at a faster pace than its current outlook would suggest.
It was a promise Donald Trump made on the campaign trail. The U.S. should rip up the North American Free Trade Agreement known as NAFTA. He also talked about slapping a 35% tax on Mexican-made vehicles imported into the U.S. And now, as Phil LeBeau reports, we're getting some fresh analysis on how much that would drive up auto costs and possibly hurt the auto economy.
Mexican auto plants are running at a record pace, and they're only getting hotter. Since 2009, the number of cars and trucks built south of the border has soared and will soon top 4 million, with almost half of those being shipped up to the U.S. That bothers Donald Trump, and he wants automakers to build more in the U.S., even threatening to slap a 35% tax on Mexican-made vehicles. What would happen if the president-elect did that? The Center for Automotive Research, which is funded by auto manufacturers, estimates the cost of the average vehicle built in Mexico would jump almost $6,500, which would lead to almost 500,000 fewer vehicles being sold in the U.S., and potentially the loss of 6,700 auto industry jobs.
Once Donald Trump takes a look at the numbers, he will find a way out of to wiggle out of this unfortunate campaign promise.
With U.S. assembly lines already running close to capacity, automakers are unlikely to put up new plants in the U.S. Instead, they would likely build some models, like small cars, in other low-cost countries, like China. That's where the Buick Envision is built. India is another option. Ford will import its new small crossover, the EcoSport, from a plant in that country.
If we close off Mexico, it becomes a game of whack-a-mole. Like, where else do you close off next? Because they're going to move from other places.
For now, automakers are still manufacturing and expanding in Mexico, including Ford, which is moving small car production south of the border. That will free up assembly lines in Michigan to build more trucks and SUVs. But all of that could change if Donald Trump plays hardball once he becomes president and follows through on threats to put a tax on all vehicles made in Mexico. Phil LeBeau, Nightly Business Report, Chicago.
And to read more about the potential impact of renegotiating NAFTA, you can head to our website, nbr.com.
American voters were clearly comfortable electing an active billionaire businessman as president, and in turn, the president-elect has nominated numerous business people for cabinet positions. Now comes the uncomfortable part, making sure that the new administration's personal business interests don't interfere or compromise with the people's business. Here to discuss how the Trump administration might intelligently avoid possible conflicts of interest is Meredith McGehee, strategic advisor with the Campaign Legal Center. Meredith, I'm glad you're with us. We've never been in a situation quite like this before. Let's separate now the question of the president and the cabinet. Is there a way for us to come up with some way that both deals with the president-elect and his business and his family interests fairly at the same time as it quarantines those business interests so that he's free to do the people's business in an uncompromised way?
Yes, actually, I think in some ways, even though he does have a very complex enterprise, the steps are fairly clear. What he should do and what has been done in the past for the last 40 years has been for the White House counsel designate to sit down with the Office of Government Ethics to look at the portfolio, and at that point they say, okay, here are some interests that you need to divest. Here are some interests that should go into a qualified blind trust, which is run by a totally independent trustee. And that trustee will then be able to make decisions unbeknownst to the president of, are there assets that over time need to be sold off? Are there some where he needs to recuse himself? Are there some that he can hold on to? But this step, this initial step, is very important, both in terms of protecting the president. If you're owner and you're not managing it, you're still legally responsible.
Absolutely. You know, there was some talk that perhaps he would turn over his businesses and his business interests to his children. But now we have seen his children attend some of the cabinet level meetings, which compromises that particular solution. What's your read on that?
Well, they have to, you know, they're kind of having their cake and eat it too at the moment, saying, oh, where we're going to have the business independent and yet at the same time participating in the transition team. Obviously, that's not the clear line that is needed here. But I want to make clear that this is also the kinds of stuff that he is talking about also raises all kinds of serious questions for the president-elect himself. He does not want to be in the position of being legally responsible for any violations that the company he owns may incur, even if he's not managing them. And of course, the last thing I think he wants is to be in violation of the Constitution and the Emoluments Clause, which really talks about benefits from a foreign state. This isn't good for him. It's not good for the country.
Is there quickly any level of conflict of interest that we could acceptably live with?
Well, I think you really have to address this right straight on. It's really hard when you're the president, the most powerful position in the world, to kind of say, oh, well, we can live with a little bit of conflict of interest, because there's no need to. The answers here and the steps are actually quite easily taken when you decide that this is the job that you want to take. He made that decision, and so now I think it's just a matter, I'm glad to see that he said this is visually important. He has recognized that.
Meredith, thank you very much. Meredith McGehee with the Campaign Legal Center. And still ahead, taking stock, looking for some names that could see big returns over the next year. Our top-rated market monitor has some of those names.
Customers are not opening new accounts at Wells Fargo like they used to. Following the fake account scandal, checking account openings plunged about 40% in November compared with last year. That decline can also be attributed to the scrapping of unrealistic sales goals that former workers say led to the creation of those fake accounts. The head of Wells Fargo's community bank said the company's top priority is rebuilding trust.
'Tis the season for giving and returning those gifts, but dealing with unwanted, used, damaged goods, very costly for retailers. Courtney Reagan is in Mount Juliet, Tennessee, where one company is looking to corner the market on returned goods.
Americans returned $260 billion in merchandise to retailers last year, or 8% of total purchases, even higher around the holiday season. According to Gartner research, less than half is resold, leaving retailers booking big losses, in some cases as much as 10% of total sales. Unwanted and damaged goods either get tossed out or sent through a lengthy chain of liquidators and wholesalers, paying pennies on the dollar to the retailer before eventually selling them to bargain-hunting consumers. Add in the surge of online shopping, and the problem gets even bigger. Return rates from online sales can be 30% or more, and that has research from Gartner warning retailers the old way of dealing with returns is a ticking time bomb.
Retailers are not very good at managing returns right now. And so unless they invest in their ability to manage returns, the volume of returns coming back will cause problems in their overall supply chain.
Best Buy is one retailer that's working on ways to recoup losses associated with returned goods, adding open box merchandise to its store and web inventory, increasing the chances of selling those items at a discount while decreasing losses. But now there's a new option for retailers. Optoro is one company working to disrupt the traditional model for dealing with returns. The company claims its technology finds the best resale price across marketplaces for retailers the moment the return is scanned at the store.
Currently, many retailers are getting 15 cents to 30 cents on the dollar for these returns because they're having such trouble economically processing them and getting them to the next best markets. We're able to get them to double and triple the recovery.
After merchandise is returned to a retailer, it ends up here at Optoro's warehouse in Tennessee. The bulk of the items are electronics, but there's also health and wellness, home and garden, baby items, and of course, clothing. The goods are tested and inspected, and once they're given a clean bill of health, they're ready for resale on Optoro's retail site Blink.com, Amazon, and eBay. Home Depot, BJ's Wholesale, Jet.com, and 17 other top 20 U.S. retailers and manufacturers use Optoro's technology. It can be a win-win-win. Retailers recoup more on returned goods, waste is reduced, and consumers get another discount shopping option. For Nightly Business Report, I'm Courtney Reagan in Mount Juliet, Tennessee.
Jan Niffen joins us now to tell us who the winners and the losers will be this holiday season. He is CEO of J. Rogers Niffen Worldwide Enterprises. Nice to have you here. Happy holidays.
Hey, great to be here. And, I'm wearing my holiday tie. We're into it already.
Excellent. Perfect. Who do you think is going to come out on top this holiday season, Jan?
Well, the bad news is if you're a brick and mortar retailer, the person that's coming out on top is Amazon. That's not going to change. It was true last year. It's actually been true since 2006. They're the #1 place for gifts right now for anybody that's getting a gift. And the #2 place is Walmart.
How is Walmart's online business doing, Jan?
Well, since they bought Jet, I'm sure it's doing a lot better. You know, Jet was running at a rate of about $1.4 billion after 14 months of operation. Now they're 16 months old. They were adding 500,000 customers a month. So Walmart's online was really trailing the growth at Amazon by a lot, even though their online business is smaller than Amazon's. Now that they've got Jet, at least the growth rate's going to look a lot the same. I think they can grow this business online at 20 to even 30% a year for a while, because it's off of a fairly small base, and Jet is a really good operator.
You know, I notice on your list of winners you have Pennies, and they tend to be mall-based, so that kind of surprised me. Why did they make the winners category?
Okay, it contradicts everything I said, that the malls aren't doing well, interior of the mall is even worse, the anchors are struggling because business isn't going to the mall, it's going either to off-price or it's going online. However, some retailers are kind of in control of their own fate. And if you're doing things better than you used to, and Penny's is doing things a lot better than they used to, you start getting business back. They're also taking share from Sears, and actually the offering they're doing now in appliances is working, and that's brand new for them, and their home business is getting better. But that doesn't mean that the mall's not struggling. It just means that they had been pretty low down on the totem pole, as you know, and they had given up a lot of sales, and now they're building that business back.
You also like some of those stores that you say are not in the malls but are across the street from the malls. Name them.
I love things across the street from the mall. So if you're TJ Maxx, if you're Ross, if you're Ulta, even Nordstrom's Rack, that part of Nordstrom's, that business, those businesses are doing well. It's really odd, but you can go 100 feet from the mall, cross the road, and it's pretty busy over there. You return to the mall, and it's kind of like being, gosh, I don't want to say at a funeral, but very, very slow. You know,
Jan, but just very quickly before we let you go, Nordstrom, you mentioned, they were downgraded today. The stock lost about 8%. What's your opinion of Nordstrom this holiday season?
I think if you're an anchor at the mall, which Nordstrom's is, you're struggling a little more than other people, other companies. So if you're Nordstrom's, if you're Macy's, other than Penny's, if you're Sears, of course, you're struggling if you're at the mall. And that's going across the board. So do I like what Nordstrom's did with Rack? Yes. Do I like the fact that Nordstrom's is one of the best omni-channel retailers in the country? Yes. And I like the fact that they're good at customer service, but they're trapped at the mall just like everybody else. Those businesses are not doing that well.
On that note, Jan, thank you. Jan Niffen with J. Rogers Niffen Worldwide Enterprises.
Sumner Redstone to step down at Viacom, and that's where we begin tonight's market focus. Redstone will resign from the company's board in February, still remain on the board of CBS, but Redstone will still control the majority of Viacom's voting shares through his National Amusements Holding Company. Shares of Viacom up better than 1% on the day at $39.50. Mylan said its generic version of its EpiPen will be available starting next week. The allergy treatment will be offered at $300 for a pack of 2, which is less than half of the full cost of the brand name variety. Mylan up a fraction at $37.82. Honeywell said earnings for the current quarter would come in at the low end of its forecast. The industrial conglomerate also says 2017 earnings, which were largely below analyst expectations. Honeywell shares up 4 cents at $116.38.
Omnicom has been subpoenaed by the Justice Department as part of an investigation into possible price fixing in video ad production. Justice is looking into whether ad agencies rigged contracts to favor in-house production units, a practice which could violate federal antitrust laws. Omnicom shares were off 2% to 86.18. And the hotel search company Trivago made its debut on Wall Street. Trivago, which is majority owned by Expedia, priced 26 million shares at $11 each. That was below the expected range of $13 to $15. Shares ended up nearly 8% to $11.85.
And now to our market monitor, as names of stocks he says could grow more than 20% over the next 12 to 18 months. Gotta love that. It's the first time on the program. Brian Smolak is top performing portfolio manager of the Hood River Small Cap Growth Fund. It is up 15%. You gotta like that, Brian. Welcome. Good to have you with us. Banks have been doing very, very well as interest rates have been going up. Your first pick is Bank of the Ozarks. Why that particular one?
There's a lot of reasons why I like Bank of the Ozarks. I do think they can grow loans faster than the rest of the industry. I think in 2017, they could probably grow their net loans by about 20% or so. They're really good at handling complex commercial real estate transactions so they can get better margins there. Also, as tax rates go down, they're a big beneficiary. They pay around a 35% tax rate currently, so they could get a nice benefit if rates go down. Also, with deregulation, they could potentially be a little bit more aggressive on the M&A front. They've recently closed some big acquisitions. Now they're through that, so that could be upside in numbers as well. And you mentioned rates. They can benefit a lot from the steepening of the yield curve that's happening. Also, with LIBOR rates and Fed rates moving up, numbers can move up on margins as well.
Western Alliance Bank Corporation, symbol WAL, is next on the list. They have been acquisitive recently, and you think they might do more of that?
I think that's reasonable. I think over the next 6 to 9 months they could do that. If there are cuts in corporate tax rates like we've talked about, that gives them a little bit more capital to put to work. Like you said, they've done some deals lately that have been fairly accretive. Over the last 8 years, they've diversified away from being solely focused on Nevada, California, and Arizona. They've become more of a national bank. I think they can grow their loans in the 10 to 12% range in 2017, which is better than the rest of the industry. And both Ozarks and WL are trading at a discount on earnings to the group on 2016 and 2017, which I also like.
Let's move in a sort of opposite direction from banking and finance to Mastech. MTZ is the ticker. It's kind of an oil and gas infrastructure play.
Yeah, they do lots of infrastructure all over the United States. They do oil and gas, and they also do wireless, wireline, transmission, and energy, electrical work as well. I do think that since deregulation is happening in those industries, they can benefit from higher spending there. The Street's anticipating around 6% revenue growth and over 15% cash flow growth in 2017. I think those numbers can be exceeded. And more importantly, in 2018, the Street only has flat revenue growth. I think they could significantly see that.
Very quick reaction to the fact that this stock is already up 100%, 115% this year. Has it gotten too far ahead of itself?
I don't think so, because as I mentioned, I think earnings estimates have to move up. Right. The reason why it's been good so far this year is because the company's gone from missing earnings to beating them, and that happened over the Q1, Q2 timeframe. So the stock had a lot of catching up to do. And the stock's at the high end of its normal cash flow valuation range, but it's not extreme. And again, I think you're on a 4-year cycle here for that name.
Gotta leave it there. Brian Smolak with Hood River Capital Management. Thanks again.
Coming up, will the Force be with Disney and its next installment of Star Wars?
Star Wars The Force Awakens set records when it opened last year, and it reinvigorated a massive franchise for Disney. Now investors want to know just how big the next installment of Star Wars will be. Julia Borston takes us to the movie.
Rogue One, a Star Wars story, is off to a huge start, grossing $29 million in North American theaters, the biggest Thursday night preview of the year, and the 7th largest of all time. Plus, it's grossed an additional $33 million overseas.
Congratulations. You are being rescued. Please do not resist.
The film's expected to gross at least $300 million worldwide this weekend, and it could generate more than $1 billion in total revenue for Disney. Though it's not expected to rake in as much as last year's The Force Awakens, it's a key test of the potential to expand Lucasfilm outside Star Wars' core narrative, with a totally new cast of characters.
I think that this is crucial for Disney. It's not just, does this movie do well, but it's the argument that Star Wars can be an annuity business rather than just a flash in the pan couple of successful movies.
It's all part of a push to turn Star Wars into an annual event to fuel not just the studio, but also demand for consumer products. The 2 Star Wars lands in the works in Orlando and Anaheim.
With Disney shares under pressure and concerns about the health of ESPN, analysts have been looking more closely at the success of the studio, which dominated 1/4 of the U.S. box office this year with 5 of the top 10 films, including Finding Dory and Captain America. And Rogue One could top them all.
It's a great thing for our movie theater and for all movie theaters, because not only does it bring people in, but it also encourages them when they come. They want to be able to have concessions, and that also drives sales here at the theater, and also drives sales for other movies as well, because when people come see the movies, it tends to breed more movie-going.
And more movie-going is a good thing as Disney heads into some tough comparisons to last year. Piper Jaffray's analyst projects Disney will top $7 billion at the box office this year, a record, and will hit $6.5 billion next year. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Have a great weekend, everybody. Get your shopping done. We'll see you Monday.
Nightly Business Report has been funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do